The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Well, today was an exciting day on Wall Street. And we are recording on Wednesday, the 18th, the day of the Federal Open Market Committee and Mr. Powell's speech to the nation.
Indeed.
Finally determining what on earth we are going to be dealing with in the days, weeks, and months ahead regarding interest rates, the direction of the economy, and all things financial. And the bottom line is, we're still clueless about where we're headed because the 50-50 debate over a 50 basis point rate cut or a 25 basis point rate cut, we now know what the cut is,
Right.
But there's still disagreement about what lies ahead. This was supposed to be the answer for the future.
Yeah. And the age-old adage about economists, if you lined every economist on earth, lined them all up, they would still all point different directions. And that's pretty much what we got today. It's that case of, good news is bad news and bad news is good news. We've been waiting for a rate cut for years now, and we finally got it. But we wanted 25 basis points instead of 50. We got 50. Well, that means trouble. So it means inflation is probably under control, but we're probably headed directly for a recession. And and if we'd gotten 25, it would have meant that inflation was under control, but we were going to get a soft landing and a nice recovery. And all it really probably means is that the Fed should have cut 25 basis points last month, and they're saying, yeah, that was probably what we should have done. So now we're right where we should have been if we'd cut last month, but somehow this month, it's all a disaster. And half of Wall Street is saying recessions are here, sell, sell, sell. And half of Wall Street is saying, we finally got our rate cut, buy. So it's total chaos from the time Chairman Powell started speaking until the end of the trading day.
Well, that's certainly true. Let's just take a quick look at some of these charts that are obviously signs of confusion. I'm going to give you a window here. I think we should be able to see that. So here's the exchange traded fund for the S&P 500, ticker is SPY. And this big green candle right here is something that we don't normally see. It's usually, it depends on whether it's green or red. Green is happy days are here. Red are, the tornado has hit or the hurricane has landed. But to have one that has a low here and a high way up here, it tops out the chart. That's just not a normal minute in the trading day.
Correct.
This is actually a 5-minute chart right here. And so what happened, we take a look at, we can see this chart. This is a 3-minute chart. Another attempt to kind of say, well, that's still pretty good news. And then the thing just cratered off until the close right down here. So there is elation. And then Mr. Market goes into depression.
Right. And that's what happens when there's no consensus here. There's no consensus. Where are we? Is that good news or bad news? It's good news. Or maybe it's bad news, and it's better than it was. Yeah, but it's not as good as we thought. So the market's going up and down into the close. And that's what happens when Wall Street is forced to make a decision. And as you can see, it becomes very muddled in the short term. And in that short term, which is why they say, in the short term, markets just are not predictable. And we know that the biggest market movers are the 50, largest hedge funds on Wall Street. That's about 50% of the shares that get traded every day. So that's what's causing the market move. They had no idea what was going on today. What do we do? Is this good or bad? We don't know. It's all to be determined still. And then they'll start following the leader again. and they'll try to get a consensus built out of it. But in the short term, in a few hours, we've got to make a call right now. Chairman Powell just announced he's cutting rates 50 basis points. Is that good or bad for our portfolio? And what do we need to do right now? And as much as they try to be ready for that ahead of time, because it's not like it was a mystery. The only question pretty much was, is it going to be 25 basis points or 50 basis points? And my view had been, it doesn't matter as long as rates get cut. What happens today? 25 basis points is meaningless. There's going to be one cut, and we're going to be stuck with it for a month anyway. So what? Just don't get too wound up one direction or the other. But Wall Street does not work that way, and so it was immediately met with a huge bout of buying, and then immediately selling, and then some more buying, and then some more selling. We don't know what we're going to do. And the bond market was the same way. Do we buy this or do we sell this? What do we do? Is this good news or bad news? If we're going into recession, well, bonds should be good. If we're going into recovery and a bull market, well, bonds should be not as good as as equities. So what are we supposed to do here? And of course, it was just all over the place today.
So falling bond rates are good. Falling interest rates are good for bonds, for bond holders, because the value of the bond that you already own is going to be worth more money as interest rates fall. Now, your interest doesn't change from when you bought it, but the fact that people are going to be willing to pay a premium for it in a lower interest rate market makes your value higher. And we see that initially here from the time of the announcement that for the next 30 minutes, optimism reigned in the bond market. But after that, Mr. Market's manic depressive behavior just set in all across the board. There's just no area that we've found so far on the charts where there was rational thought processes of what this means. And you just mentioned, Perry, that what's a quarter point worth anyway? A quarter point reduction at the Fed is not going to change mortgage rates enough to attract a bunch of buyers.
Correct.
There is a loose correlation, but it's certainly not immediate, and we still have inventory problems, a shortage of available
Correct.
housing. As long as there's a shortage of a product, any demand is going to support the price. So here we are looking at the long-term treasury. It's a 20-year treasury in the ETF TLT, and this says interest rates are actually going to rise. We're going to get out of bonds here, and this doesn't make any sense. When we look at the 10-year treasury yield, TNX hyphen, I got the wrong one. How about that? TNX-X. Here we go. So here is Mr. Powell speaking. Interest rates are going to fall. They're going to cut them 50 basis points. That's 0.5%. If you don't know what a basis point is, it's basically a penny. So we're going to cut them 50 cents, 1/2 of 1%. And we see rates rising. We see rates falling. We see rates rising. And we end the day at at 385, which, as I said to you, Perry, before we started, is actually higher post-announcement than we were this morning before the market. This is my pre-market analysis of what's going on. And here we are. The TNX was rising at 3677, and it just closed at 3685 with lower rates announced. That doesn't seem like the natural conclusion to a lower rate environment. So
Correct.
is the assumption here that lower rates mean that consumer debt's going to be cheaper, so consumers are going to decide they can afford to borrow more money before they become fiscally responsible with their household budgets?
Right. Is that what it means? So, yeah. And the answer is no one knows what it means. And that's, this market, this trading action right here is one of the reasons we never recommend anyone make any trading decisions based on, well, if there's a Fed announcement today, should I be buying it or selling it before the announcement? It's like, no, you shouldn't be doing anything before the announcement, and you shouldn't be doing anything immediately after the announcement. We're not waiting for the Fed to announce what they're doing and then all of a sudden make a portfolio change. There's no data to support that you have any idea where it's going. And don't forget, this market move is being driven by, this is the smart guys. These are the smartest people in the room. These are the people managing the biggest accounts on Wall Street. No consensus at all about where it's going to go right now. So the best move is, wait for the dust to settle and see where this ends up. There's highly likely to be some consensus of some kind going forward, and that's going to form a trend. Follow that. That's our process. That's what we do. Because looking at a market like this, you're talking in circles because everything is, well, this is very, very good. Well, wait a minute. Next minute, that's very, very bad. And it goes back and forth and back and forth. And there's no direction. There's nowhere to go. There's no winning trade here. There's no way to play this. It's too chaotic. It's a really good time to wait for the dust to settle and see where things end up after the fact, because there's going to be other metrics come out. I mean, the economy is not going to stop running, and we're going to get more metrics in here, and we're going to find out about the strength of this economy, and we're going to see the next jobs number, and if the jobs numbers are getting better and better, just like last time, it's going to be like, well, how do we have a recession if unemployment's going down, not up? It's like, that's a very good question. So you can continue to watch that, and it'll sort itself out. But boy, in the short term, it just turns to a bowl of mush that there's no defining one side of the bowl from the other.
So this morning before the market opened, Jamie Dimon at JP Morgan and Ray Dalio at Bridgewater, both of whom are very wealthy, successful money managers at very large investment banks,
Correct.
both said, we expect a 50 basis point cut because the Fed's behind the curve. Bloomberg did a survey of, I think, about 20 economists, and their consensus was, and it was like 16-3, said, we don't need more than a 25 basis point cut.
Right.
Because their view of the economy versus the money manager's view of the market, each of them have different objectives in terms of what they want to accomplish, and the data that they're looking at should be the same, but the interpretation is different. And so we end up with this muddled net effect here. So when we turn around with falling interest rate should mean that we have a falling dollar, and this is an exchange traded fund for the dollar. It's a bullish index, but falling rates should cause the dollar to rise, which it did not do initially. After a half an hour, we got buyers for the dollar to come in here. Actually, I'm sorry, I did that wrong. A falling interest rate should be a falling dollar.
Correct.
And maybe this is short covering, where people who had been short the dollar decided that that's enough profit for me. I'm going to go ahead and sell this and take it out. And it started a short squeeze, forcing others to buy the dollar, moving it up. But again, rationally, based on financial theory, this shouldn't be happening. You got lower rates and the dollar's getting stronger. Lower rates should actually be causing problems in Japan, because of the Japanese yen carry trade is borrowing money at next to zero. It's no longer zero, next to zero in Japan, putting money there at zero in the bank, and then borrowing against it to buy here, to buy dollars here, and then leveraging the dollars to buy securities here. It's a highly volatile trade. And when it went upside down last month, I mean, it was a massive couple of days in the market, and it took several weeks to recover. With a rising dollar, that takes the pressure off the trade, but a falling interest rate should cause this to drop. I mean, you want to talk about guys who are probably losing sleep tonight,
right,
on Wall Street. I bet there's a bunch of them, because they're just hoping they don't get a margin call. But that EWJ, actually a falling dollar should be good for Japanese or any international security. But so here it was, interest rates are falling. Hallelujah. That's really going to bail out Japan. Oh, I don't know if we have a clue what's going on here at all.
What's happening here? Yeah.
Earlier in the year, we had a portfolio that had some exposure into Japan,
Yes,
but as things started getting murky, we just sold the position and said we can't figure this one out. This is beyond our understanding of what's going on in the currency market. So we sold it, and we have no regrets that we that we
it
left
was
the
right.
trade
It was the right
because
move. Yep.
we missed the conflagration of the first carry trade collapse, and this could easily cause another one. Uh, Real estate exit. So let's see what real estate did. Same kind of thing. Interest rate falling should be good for real estate. So there's two components to real estate. Most of us think of household issues and mortgages if we have a mortgage, and then that should help promote real estate sales because the mortgages are going to be cheaper. But as I said earlier, a quarter point reduction in the Fed isn't going to change mortgage rates enough to create a new wave of interested buyers. We need more inventory. Inside the real estate market, there's a lot of components. Residential, of course, and then there's commercial real estate, office spaces, there's warehouse spaces, there's shopping center spaces, and those last three that I just mentioned are all in trouble with vacancies. And
Right.
they have mortgages, which are not 30-year mortgages as a general rule. They're 5, 7, 10-year mortgages that are all up for renewal here in the next couple of years. And with no rents coming in, properties are just being given back to the bank. So if interest
That's
rates
a
are
problem.
lower, maybe they'll be able to refinance. So this excitement here is a reflection of that bet. But on second thought, if the Fed has to cut 50 basis points, maybe they aren't telling us the whole story. You
And that's
know?
it. And in the real world, especially in investing, it's never one thing. It's never one thing. It's just too complicated for that. And it does go on and on and on. We've probably gone on long enough, Don, to confuse everybody. I know we are. So we may want to to rein it in for this podcast.
Well, our process is to look at actually what has happened and where the trend is. And right now, today did not clarify the trend.
Mm.
So as you said earlier, making quick decisions, betting on what the Fed is going to do, it has a 50-50 chance of being terribly wrong. We need to see what happens in the next few days to which way the trends actually make an adjustment. So down at the bottom of the screen, there's a place to subscribe. Follow us on YouTube. Register for our next webinar. Go to iriradio.com for the website and register. If you do that, we'll also start sending you our weekly update that we normally send out on Mondays as long as the market's open on Monday. Anyway, thanks for being with us. Have a great day and stay tuned, stay connected, stay subscribed to catch our next podcast.